Hello everyone, welcome to my Saty phase oscillator indicator overview video. I'm really excited to give this one to you guys. I know it's been a long time since I've been sharing the oscillator on social media, and a lot of people have been very excited about it. There's a whole group of people that joined the beta, the private beta, and I do want to thank all of those folks for the support and for getting early access so they could test it out and use it for themselves. And I'm really pleased with the results and seeing everybody enjoying it and being able to use it to help themselves. So that being said, thanks again to the beta folks, and I really appreciate you all. Before we begin the presentation, I just want to remind you that this presentation is not financial advice, and I'm not a financial advisor. So if you decide to use this indicator and you decide to take some trades with it, those trades are your trades and your trades alone. I really, really recommend that you go and look at price and look at charts with this indicator before you decide to jump in and use it in live trades. But that being said, I hope you enjoy it, and I hope you find some value in what I have created for you. So today we're going to go through a bunch of things. Why did I make it? What does it look like? What are the basic features? And then we'll put it all together and look at how you may have been able to utilize it to take some trades on the SPX daily chart. So why did I make it? There are a lot of really great indicators out there. There's some people that don't use indicators. I think that's perfectly fine. I'm a price volume guy, so I started from no indicators to adding some, and then adding more and adding too many, taking off many, and then started to build my own system. So I've gone through the whole gamut, and I think that there are some really nice benefits you can get from some of these indicators to help you kind of understand where you are in a market. And I wanted to look and see if I could get those benefits into a single package. Obviously it's hard to kind of take all of those pieces and put them together and just sort of cobble it together into something. So it had to be something new. It had to be from the ground up. So that I could, get those advantages, get those benefits, but also provide potential new advantages and optimizations, focused on being as close to price as possible, being fast and, available and working for both, short-term trades all the way to long-term trades. So this has been a long journey. I started this about 16 months ago. I've been doing a lot of development, a lot of late nights, a lot of discussion with folks as I share shots. A lot of questions people have asked me that have been probing questions for the, that's allowed me to sort of think about things and get better and, make things better and improve things. So this code is very simple at this point, but it didn't start that way, and it certainly went through a long journey to get to where it is. This certain, this current refinement that I've created. So, sometimes things will look very simple when you're done and obvious, and those are sometimes some of the most beautiful products. Of course, this is my own product, so I think it's great. That's up to you whether or not you think that's true as well. But to me now, when I look at it, I'm like, this is obvious. It's so obvious once it's done that it makes sense, and that's exciting. So that being said, I don't expect this indicator to replace your favorite indicators, right? I don't expect it to replace RSI for you, or MACD, or Keltner channels, or Bollinger Bands, or any of those indicators, right? It's not meant to do that. It is its own thing. It's not going to, have all the same fidelity as each one of those indicators that have multiple purposes. It's simply taking some of the benefits of those indicators and putting it into a single package. So it may or may not work for you, and I think it would be best for you to go through and kind of appreciate what's going on under the hood and what's happening before you jump in and start using it for your own trades. So here's what the oscillator signal looks like, and we'll talk a little bit more about what this is, but I just kind of want to show you. Most of you should be familiar with it. Of course, anybody who's in the beta already knows what most of this looks like and what it means. Those of you that are getting access to it today, I think you'll be able to follow along and start to look at price later. look at your charts and try to understand how it relates to it. But it's pretty simple. There's a grid, there's an oscillator signal, and then there's a label. And we'll talk a little bit about each of those pieces in just a moment. But before we dive in, I want to talk about the 4 indicators that I was inspired by and the benefits of those indicators, usually singular. In one case, I think there's a couple of different benefits that I was trying to extract. Like, I don't want to get everything from those indicators. I don't want to try to take every element and, kind of put it all in one. That just gets complicated. I'm trying to simplify things. So let's talk a little bit about what I like about those things and then how I pull those concepts into the Saty phase oscillator. So the first concept is Keltner channel range. So, an oscillator generally is going to be a range-based signal. Most oscillators, or many oscillators, typically will have a fixed range. Things like RSI are going to have fixed range. So Keltner channels are quite useful. And if you're not familiar with it, it's essentially just a EMA with a plus X ATR and minus X ATR upper and lower bound. So in this case, it is a simple moving average 20 simple with a 3 plus 3 minus 3 ATR upper and lower bounds. And you can see it sort of largely stays within that range. Sometimes it'll go out of it in stronger momentum, but generally it's going to, when it gets to the top of range, it comes back and mean reverts, top of range, comes back and mean reverts. This is incredibly useful, right? Being able to see kind of where you are within the range and looking for extremes and being able to see that, hey, it's likely that we're going to get some sort of a reversal or at least mean reversion through time or price. That's incredibly useful. So that range-based signal off of the Keltner channels is a core element of what I've sort of implemented in the phase oscillator. Just done it in a very simple and kind of elegant way. But giving you similar benefits that you get from this Keltner range while putting it into a oscillator signal. The second thing I want to talk about is Bollinger Band compression. So those of you that are familiar with the Bollinger Bands, incredibly useful to see these compression signals because it essentially is saying, hey, there's low volatility, consolidation, and then after this you're going to get a move, right? So small range leads to big range. So the beauty of the Bollinger Band compression, when you get these compression signals, it's incredibly useful, right? Because it's essentially signaling that small range is about to lead to some big range. So super useful feature of the Bollinger Band compression. It's very, very important and very useful for identifying potential places to trade. So the third piece, RSI is an incredibly common indicator used by so many different people, and I think it's got to be MACD and RSI are probably the 2 most commonly used indicators outside of price and volume. Candles and volume candles, RSI is super helpful when you get divergences between price and the signal. Often you'll get some sort of a mean reversion or you get a reversal, and that can be incredibly useful for spotting potential trend change or the end of a trend. And you can also use it to signal strength and weakness in a particular market when things are sort of extended or overbought, oversold, or the terms that are used there, which I hate. I hate those terms. I think they're kind of selling you the wrong idea. But let's just keep it as strength and weakness, and I think that's incredibly valuable. And stochastics do something similar. So, phase oscillator also is going to give you a similar signal. It doesn't use RSI. It doesn't use the same algorithm as RSI. So it's going to be different, but it does provide you kind of a similar signal. And when you match them up, you'll see that they end up being pretty similar because they're both based off of price ultimately. And then the next thing is the MACD. Obviously, the most useful feature for most people, I think, is the MACD crossover when you're looking for confirmation. You can see here there's a potential uptrend that's happening. It's a box breakout that's about to happen. You get confirmation of a crossover on your MACD, and then you get movement to the upside. Same thing here, crossover, movement to the downside, crossover, movement to the upside, etc. So those crossovers can be really useful. And in the phase oscillator, it also doesn't use MACD. It uses a slightly different system, basically using the Fibonacci grid, and crosses against that grid you get kind of a similar result as the MACD crossovers. We'll talk a little bit about that in a moment. So those 4 pieces are very, very helpful for traders. It's a lot. It's a lot to put on your screen. It's a lot to sort of digest and analyze, especially if you're a shorter term trader. It's a lot to have going on at once. So obviously, for me, for some people, you're okay with that 15 indicators. I'm not okay with that. My goal is to have fewer indicators, as few as possible. And the phase oscillator is really end goal is to reduce how much I have on my screen at any given time, and to make trading a little bit more, a little easier, if you will, easier to analyze anyway. So let's talk about the basic features of the phase oscillator. So there's 3 basic features. It's an ATR EMA based price oscillator. So we talked about the Keltner channels. That's a central core aspect of the price oscillator algorithm. There's a Fibonacci based grid. Those of you that are familiar with ATR levels and you watched the first ATR levels video when I first built it, kind of the levels that I chose back then were the 0, 23.6, plus or minus 61.8, and plus or minus 100, and those are the same levels I've chosen for this Fibonacci grid as well, and they unsurprisingly work well for this grid. And Fibonacci continues to be one of the best things in trading, and super useful seemingly in almost every aspect of trading. So that's the second piece. And then the third piece is a 3-color system for viewing momentum, compression, and expansion. So I think those 3 pieces, when you put them together and looking to provide the same benefits as the other indicators that I mentioned, you get something pretty cool. So let's talk about the price-based oscillator. So I use all EMAs. I love the speed of EMAs. I think that provides a faster, more weighting to short-term price or closer price action, which I find valuable. So I leverage the 21 EMA and the Keltner channel concept of using ATR away from an EMA to essentially then take a difference in price relative to that range to create this uncapped but typically range-based signal. And this signal allows you to do a lot of the same things that you see with RSI, where it's within the range. You'll see you've got when it's sort of extreme, when it's just strength or weakness. But the uncapped nature of it also allows you to see really extreme momentum and then take action on that when the momentum wanes. Incredibly useful, and that uncapped signal you'll see in things like NVIDIA, things that have really moved strong in a strong way. It's actually a useful signal to have it not be capped, to have it not be sort of just sitting at the top of that boundary. And then also I add a smoothing on the signal to give you some short-term trend at the front of the signal. I call that the compass. So you'll see it when price is moving during the day. The front of the oscillator signal can vary, right, based on price. As price is changing, as the candlestick is changing, it's going to affect that signal, and it'll give you kind of a short-term trend, which is incredibly useful. And then there's also, because of the smoothing, it tends to create better divergence signals overall relative to price. And that is not always true, but I think I've found in most cases the divergences are easier to spot and super, super nice, super clean. Let's talk about the Fibonacci grid. I talked a little bit about it before, but essentially we're splitting the range. The basic range from 0 to 100 and 0 to minus 100, we're splitting that into those, Fibonacci levels that I mentioned, the 23.6, the 61.8, and the 100 with a 0 line in between them, and of course minus versions of those as well. And what I found is these levels can be used as inflection points, can be used as support and resistance on the signal itself, and can be used as crossover signals for confirmation, similar to MACD. So like if you get a move above the 61.8, it can typically be like a MACD crossover saying, hey, there's going to be a bullish move to the upside, and it's confirmed. And then, the position of this signal within this range, within this grid, can kind of be connected to the 4 phases that align with typical Wyckoff phases of accumulation, markup, distribution, and markdown. So the final piece then is a 3-color system for viewing momentum, compression, and expansion. And that's on the oscillator itself. And the 3-color system allows you to see the strength, the weakness, and Bollinger compression, and then gives you actionable signals to use that for your trade. The compression signal specifically when you see that it's followed by either green or red can give you very clear indication that there's going to be a directional move, and there's going to be expansion in the direction that you're looking for, taking the trade in. So here is the same view. So when I showed you what it looks like, here's the same thing that I showed you before, but now I've labeled it with all of the pieces that we can talk about, all the important pieces. And we'll start with the 0 line. We'll start with the grid, and we can work into the signal and then talk about the label at the end. So the 0 line is segmenting momentum. This essentially is saying, above the 0 line is going to be bullish momentum, below the 0 line is going to be bearish momentum, and of course the fade of that is going to be losing momentum or losing momentum to the downside, and now losing momentum to the upside. And so the 0 line is delineating that. You've got these 2 levels in between, 23.6 and minus 23.6. That's the neutral or launch zone. Typically, when you have consolidation, you're going to be in that range before a movement one way or another. And often that consolidation will also manifest itself into low volatility, and you'll see compression, and then you'll see expansion afterwards. So super useful. Lots of trades can be taken off that launch zone after consolidation once you get sort of a breakout or breakdown of that range. Of course, confirmed against price as well. And then we've got this greater than 61.8, less than 61.8, is the down to about minus 100 up to plus 100. Accumulation zone, this is where buyers are looking to step in for getting into a position. Sellers may be trying to exit or trade, and then typically you'll get a mean reversion after that. Same thing on the other side, distribution zone. Typically you're going to start to have sellers stepping in, and then buyers may be no longer interested or waiting for some pullback to be able to get back in for some reaccumulation. Above that, you've got greater than 100, that's extreme. Greater than minus 100, less than minus 100, extreme as well. Those extreme uncapped values are incredibly useful. It really, and I'll show you once we get back to the full SPX chart, I'll show you what it looks like. But those extreme zones are typically going to lead to some sort of mean reversion or potentially reversal. And so you can leverage that to kind of get a sense of where we are. Particularly once you get to the extremes, looking for divergences in price against price is going to provide you with really interesting and useful reversal signals. So then we've got the 3 signals on the oscillator. So you've got the grid, you've got the 3 signals on the oscillator, three colors. Red is showing you the weakness. Green is showing you strength. Of course, the trend of the oscillator matters. You want strength up, right? This is strong. Strength is, when the green signal is moving up, that's strength. When it's starting to come back down, that strength is waning, right? And it's probably going to wait for some support, or it's going to reverse. That's typically what's going to happen. Same thing, but opposite on the red side. And finally, you've got the magenta compression signal. So again, this is just illustrating with the Bollinger Bands compress. One interesting thing that I've done here is, I look for different compression and expansion thresholds. To the compression, I don't mind happening. Like, I want it to really confirm that it's a true compression, but expansion I want as early of a signal as possible, so that you can actually leverage the expansion signal when it turns to green or it turns to red. You can actually leverage that as a potential entry if you want to. If you're not accumulating during the compression signal, you don't have a clear sense based off of price which direction it's going. You can wait for it to confirm before you start to get a piece of that trade. Off of the compression signal, though, typically you're going to get bearish expansion or you're going to get bullish expansion when price starts to move. Again, you can see bearish expansion here. This was the reversal that we had recently on SPX, and I'll show you in context shortly. And then the final piece, when you do get a compression signal, since those compression signals are super useful, it will flash a label, right? And it's a high visibility label. It's also magenta to really be in your face, like, hey, this is something you should probably pay attention to. It's likely that there's going to be consolidation, and we're getting compression, and there's going to be a move soon. So it'll give you an opportunity to potentially get into that trade, or start to look for opportunities in that trade in the near term. And so that's it. That's the phase oscillator. And let's take a look at it kind of just clean on a SPX chart. So I do have my pivot ribbon here. I didn't put the ATR levels on this to keep it a little bit cleaner, but I do have the pivot ribbon. This is an adjusted version of the pivot ribbon. So it's not the one that you get off of the website right now. I will be releasing updates to all of the indicators over the next month. But right now, this is just an updated version. That doesn't matter. You can kind of largely ignore that. Just the most important thing to know is the center line is the EMA, the 21 EMA. Everything else is not as relevant. I'm using bias candles and other things on here as well. But you can kind of see, it matched the oscillator works really well when you look at it with price. And let's kind of deconstruct this and talk a little bit about this SPX chart going back to October. Now, if you guys are familiar with what happened in October, this is the handle from the weekly cup and handle that I talked about back in February 2023 that has been playing out and that is almost done, and we've been following now for a long time, and for as long as I've been working on the oscillator, in fact. And let's jump into it. Let's diagnose this. So there's a lot going on. Let's start with the first thing. So after this downtrend that we had back in October, there was a beautiful divergence that set up on the oscillator, right? You also had some compression here at some point off of rejection of the 48, which led to a nice move to the downside, creating this divergence, and then this divergence led to a beautiful reversal. You can see that it was in the accumulation zone where buyers started to step in. You got mean reversion the first time. Buyers started to step in again, and then the rest is history. So beautiful signal that you can see right here with the divergence. So price is making new lows. Oscillator is making higher lows, right? And that divergence leads to some really nice moves. You can start with mean reversion, and then if you get, continuation, you can continue to play that to the upside. Or vice versa on the downside. We can talk about that in a second. So again, these extreme signals are useful because when you get to these extremes, it means, hey, probably a good idea to look for some sort of divergence. And I think that's also fair when you get past the 61.8. Once you get into the distribution and accumulation zones, you can start to look for divergences. But when you get to an extreme signal, looking for those divergences can be incredibly useful. So I think that's a really important thing to watch for. Of course, not all divergences will result in a full mean reversion, but typically you're going to get a mean reversion, right? So in this case, we had a divergence. Again, price is going, now in this case, price is going up, so you're making new higher highs on price, and you're making lower highs on the oscillator, leading to a mean reversion back to the 21, right? Get back to the 21, we're sort of in range. We start to get a consolidation signal, this compression signal, and perfect place to accumulate for, it's holding the 21, held the 21 again, perfect place to accumulate for a move to the upside. Of course, you can see a bullish expansion that happens after that signal. This is just showing strength. We're in distribution zone, but it still continues higher. We are getting mean reversions, throughout. And if you look at lower time frames, you'll see like the 4-hour and the hourly, you'll see that there's opportunities to play those extreme signals as well as divergences for mean reversion. So often when you get to these points where you're sort of in an extreme area, you can look. And price went down, but you can look at lower time frames to see divergences there that can typically result in the start of a mean reversion on a higher time frame when you're at these higher levels on the oscillator. So recently we had this downside move where a lot of people were calling for the end of the world. A lot of us were not scared, but there were quite a few people out there that were like, everything's going to fall apart. But this is where I think having something like this can actually help you. Obviously, we have the ribbon, and that helps a bunch too. But I even mentioned it. I initially thought we were just going to get a pullback, and then I thought the consolidation might hold. And as long as the 21 would hold, we'd be able to move back up. Now, once that broke, so we got the mean reversion off the divergence here, right? So price going higher, oscillator going lower. lower highs. These are higher highs. Mean reversion. So we got the mean reversion. We held the 21, bounced a little bit, but couldn't hold it. And once we started to break down the 21, it was clear that there could be a potential for reversal. And I think at that point I was like, all right, it looks like we're going to get to a weekly mean reversion. So this is a good example of where you're looking at a lower time frame. Things start to break down on the lower time frame, and you can potentially lead to a mean reversion on a higher time frame. And so in this case, we got some compression, and then it moved to the downside. I think this was the week where, it was like an OPEX week or something where we actually capitalized on this massive move to the downside. So we have this compression signal, and oscillator is trending down, and then we finally reach accumulation zone, and then we cross over, right? So we cross back over it, and that starts to signify a potential reversal. We actually caught this too. This is where, if you guys remember on Twitter, I started talking about the 4-hour structure, and we started to shift back to a nice 4-hour structure with higher lows and higher highs. And we saw some hidden divergence on the 4-hour phase oscillator as well. And that actually took us back now up to where we were just a couple weeks ago. So, you can kind of see that. Then we got back up here into the distribution zone, started to have some resistance here. And again, some mean reversion back to the 21. And now we're back in compression again, and it's looking like there's a potential for us to maybe pull back a little bit and then continue higher, as long as we get some breath in the markets, or the leaders continue to stay strong. Things like Apple are starting to heat up. It's been showing great relative strength the last couple of weeks. We've been in a trade to 200 for that one. So that's it. When you put all these pieces together, it provides a ton of data in a very, very compact package. Of course, you have to do some diagnosis, and there's plans for making this a little bit more automated and a little more helpful, maybe giving you some arrows and giving you some auto divergences and things like that. But I think for the most part, being able to spot these divergences is pretty straightforward. Being able to see the compression, being able to see where we are in accumulation or distribution or extremes, can provide hey, check this out. Maybe there's an opportunity to play a mean reversion here. Mean reversions and reversals are some of the hardest things to trade. So this kind of opens that up for a lot of people that struggle with those, understanding how to trade those kind of trades. And so I hope you find it useful. It works on all time frames. I've used it on the 1 minute. I've used it on the monthly. Again, it's not intended to replace any other indicators. It's its own thing. It's its own animal. It's using its own signals. It's using its own algorithm. So it's not meant to be a replacement for anything, but maybe you'll find it useful enough that it's able to give you the signals you need to be able to take effective trades. And ultimately, for me, it provides me all the benefits of the things that I wanted before in a single package where I don't have to really look for a lot of things. That being said, there are some indicators that I just simply have a hard time letting go of because there's nothing that can really replace them. I don't think you can fully replace Keltner channels and Bollinger Bands. I think there's additional benefits that you get from looking at just viewing price against those. Right? I think there's some benefits that you get there. I think a lot of that is coded in here, but there's some things you just simply don't get unless you're visualizing price against those ranges. All in all, I think this is a fantastic piece of my tool set, and I've found a lot of value for it myself. Your mileage may vary, and I look forward to hearing how you find it, and if you find it useful, would love to hear from you. Let me know what you think. Post a comment, send me a DM, or let me know in Discord. And that's really it, my friends. That's the indicator. This is 16 months of my life. I do a lot of this work because I want to get better. I want to improve my trading. I'm on a constant journey to try to make things easier for myself, to make analysis easier for myself, and so I can be a more effective trader, spend less time, and be more effective. And it has been a great joy to be able to share this work with everyone, and to do it for free. So I hope you enjoy it, and I'm really excited to see what you guys find with it, and I hope it helps to improve your trading. All right, and on that note, much love. You guys all take care, and happy trading.